Thank you PMS Bazaar team for giving me this opportunity 6th time in a row. And I remember the first time Pallav and Daniel spoke about this event we did in Taj, Santa Cruz, about 150 people. And I'm told today 700 plus 750 people registered and have come across. So big congratulations to them. And in personal domain, I gave him a target that we should have 1,000 investors. So please find out a bigger hall for next time. Yeah. Getting on a topic, we have a very interesting topic, the secrets to multi-bagging portfolio. And we have a very excellent panel of investment managers who have delivered excellent 5 to 10 year of track record. So gentlemen, what I did during the day and during the last few days, I kept asking the investors what they would like to hear from each one of you. And the first thing everybody said is that they want to know how the multi-bagging ideas. Unfortunately, I told them, you can't get that. But I told them we'll find out the recipe how to identify multi-baggers. Yeah? So we'll try to do that. In the next 35 minutes left now, we'll try to find the recipe. And what I'm going to do is I'm going to wear the hat of an investor and trying to get my doubts cleared of what it takes to create a multi-bagger. So one of the first things that come into mind is, does the underlying market cap, which is small cap, mid cap or large cap, does that create a multi-bagger portfolio? And I think, let me start with to my right, Siddhartha. You, I think, focus on one strategy. He focuses on small cap. The last 10-year CAGR is about 37%. So the question to you is there, does small cap, the underlying market cap create multi-baggers?
So Nimish, to be honest with you, I don't think so. It's about market capitalization. There's a big myth in the market that small caps make multi-baggers. In fact, I would say that more than 90% of small caps are actually junk. And you can also actually make money out of large caps or multi-baggers out of large caps. You look at stocks like Larsen and Toubro, or you look at stocks like ITC, or so many of the PSUs, even State Bank. ICICI Bank has been a 10-bagger over the last 7-8 years. So it's a myth that you need to go to small caps to find multi-baggers. Rather, my advice is that you're better off in the large cap space. And in the Nifty itself is a multi-bagger. I started my career in 2001, and Nifty from 800 is today at close to 20,000. So in 20 years, Nifty has gone 25x. So it's a myth that small caps make for multi-baggers.
So I mean, I look at it more from wealth point of view, wealth generation. So size of capital that you can deploy. You deploy 1 crore, you make 20x, you deploy 100 crores and you make 15x. Tell me, I mean, choice is very clear. So wealth creation or, this is multi-bagging portfolios. Everybody has a stock. I mean, just identifying 1 or 2 stocks doesn't create. Over a long period of time, if you want to create multi-bagging portfolios, then your process should be to identify something which is earlier than the market. So if you don't have a differentiated view to the market, it will not be a multi-bagger. If everybody in the room agrees with something, more often than not, it's not going to be a multi-bagger. So investing, you have to do it alone. You will not find too many. It's your own research and own conviction. On borrowed conviction, you can't create multi-bagging portfolios.
But you own about 60% in your portfolio of small caps.
Yeah, SEBI definition, yes. But the smallest of small cap is 8,000 crores or $1 billion now. So I think, top 500. See, Indian market has demonstrated the breadth and the depth. Breadth has always been demonstrated over, if you cut it amongst decades, there are, so many wealth. It's not like US where last 10 years was 7 stocks. And if you are not in those 7 stocks, you have not created multi-bagging portfolios. So we have a large pool to choose from, and all of us sitting here have done well with different stocks. So
absolutely,
that's
without doubt. Any difference of thought, Bhavin bhai, or the same?
So largely, I agree. What I would say is that, at least in my experience, if I am able to find one large cap stock, like if I look at the performance in the past, that has delivered, the definition of, I asked what is the definition of multi-bagger portfolio. and I was told more than 25% return annualized. So if I can find one large cap, I would have probably found maybe 2 mid cap and 3 or 4 small cap names. So in other words, the opportunities are there across the market cap. It's probably easier, at least I have found it easier to find more opportunities in smaller market cap companies because they are generally under-researched, often under-owned, and as a result, available at a price that meets our criteria. I think also important what criteria everyone follows in investing, and at least in our case, we've been able to find more opportunities in small and mid cap.
So in short, the answer to the question for the first is there. It is not the market cap creates wealth. It is the underlying process, philosophy, and the opportunity and buying it early. So question number one. Question number two, there's again different books, different style of investment says, does concentration in stocks or concentration in portfolios or sectors, does that create multi-bagger? And Samir, I know you own only about 8 to 12 stocks. So does that create multi-bagging portfolios?
So there are many ways to skin the cat, but for us, concentration has worked. I mean, we have such deep research, and after you have identified a company, you have met them multiple times, you have enough conviction in top-down, bottom-up management, everything, and then you go and bet 2% of portfolio. I mean, it doesn't make sense to me. Then you don't know what you are doing, or you are trying to hedge your bets. How many stocks in a lifetime that you need to really create large wealth? I mean, every large investor, and we all read books, so what is written in books is all known, but you see the practitioners, where has large wealth been created? And biggest example in India is Rakesh Jhunjhunwala and Titan Lupin Crystal. I mean, it's like that. So concentration for us is the mantra. It's worked well for us, but mindless. I mean, if you've not done your work, it is a double-edged sword.
Interesting. So you have the men in the center saying concentration works, and Siddhartha wants to step in and answer that. Please go ahead.
No, so I think, I'll slightly, kind of deviate here, and I say, I think concentration is not necessary.
Not necessary.
Right.
Okay.
And I'd say that typically for us, we work with 16 stocks, 6% each, because investing is all about the future, and the future is uncertain, right? So we follow that philosophy. And I personally feel in my own I've invested in thousands of stocks, maybe hundreds of stocks, not maybe thousands, but hundreds of stocks over my 20-year investing journey. And my biggest learning has been that if I would not have sold a single stock, I would have probably been better off than what I am today, right? So I think it's kind of, overrated. The whole idea that you need to have concentrated bets. You're okay, some of the best fund managers, whether it is Peter Lynch or whether it is my friend Samir Rash at Nippon, they own more than 200 stocks. Peter Lynch owned more than 500 stocks. So it's highly overrated according to me. Sure. You're better off just buying the right stocks. In fact, my advice to anyone who's starting their career is, first 5 years, every single month, invest into new stocks. After 5 years, you will learn, by paying a small tuition fee, what worked and what didn't work.
Sure. So there, Bhavin bhai, you own a very constant position in some ideas in your portfolio. I don't know how this portfolio size, but I read in your website that you hold a constant position in few. So what's your thought on the ideal portfolio size?
So actually, we used to have up to 30 stocks, and we now increased it to 35 as our size grown. And because we have very strong risk management criteria in terms of how we want to buy or sell any stock, and in terms of the impact cost that we would incur while buying, based on the liquidity in the market. Because one thing we are aware of is that the mandate we have, especially the PMS and actually also our AIF, is where clients can ask for money back anytime. If I had a mandate which was, say, 5 or 10-year mandate, where investor is not expected to come back, I could take much bigger bets because I know that I'm not going to have to return the money in the middle when maybe something has gone wrong temporarily, and there is a cash call or redemption call. So I think the concentration to some extent should also depend on the nature, the portfolio construct in that sense. And so I think, but I do agree that making some large concentrated bets definitely helps when other criteria is satisfied.
So interesting. On the center, the person says 8 to 12 creates multi-bagger portfolio. To my immediate right says 15 to 18 stock creates multi-bagger portfolio. And to the extreme right talks about 30 stock portfolio in terms of this. So there is no one size fit all. We'll move to the third question. So does style of investment create the multi-bagging portfolio? There's a lot of style which says value style of investing, contra style of investing, growth style. And you, I think, follow the contra style, right? So maybe start to my immediate right, Siddhartha, and ask him that, does the contra style create wealth?
It's like saying blondes and brunettes, you know, and everyone has their own choices. So, but I'd say that, you know, for us, it's a combination of all three, right? And typically you have to wait a long time for it, but eventually you get that. So the first criteria for me, for an asset class, whether it's stocks or anything else, is it has to represent deep value. It has to represent deep value. Okay, and stock market is one place where stocks guided from 10% of intrinsic value to 10x of intrinsic value. That's how you have the multi-baggers in stock markets. So first is, you know, you want to buy not just at say 70-80% of intrinsic value, but much lesser. And stock markets do offer you that opportunity. Second is stocks get re-rated only when growth comes in. Yeah. Right? And we have seen that. We have seen that recently with capital goods or infrastructure stocks where everything is getting re-rated. And the funny part about the stock market is that it's very myopic. What it does is it takes the last 2 quarters results and extrapolates it to infinity. And that's why you have at peak profitability, peak P multiples. Yeah. So you're waiting for growth, right? For that you need to understand cycles, which are, you can predict the cycle, but you can say, okay, the direction, but you cannot predict where it is going to start. It can happen that you buy a stock and it can take 2, 3, 4 years for the story to play out. So in that time, the value protects you. Growth eventually, most industries and my belief are cyclical, so growth eventually does come in. And finally, to find all these things, you know, typically these will represent a very contra bet. So contrarian investing is very, you know, it's easier said than done. It's a very, very difficult thing to do because when you are absolutely right, nobody believes in you.
Just a quick follow-up question, because since a contra, you're playing on the, you said 3-4 years it takes, but that unlocking happens. Do you exit your stock or again you play the growth story? How does it work?
No, so you obviously have to, if you want multi-baggers, you have to buy into absolute stupidity and sell into absolute stupidity, right?
Interesting.
So the same infra and cap good stocks were available at 50, 60, 70 P multiple in 2007. And all those people who had bought those stocks in 2007 are out of the markets.
Right.
And the new guys don't know about any of the capital goods and infra stock. Right. So they were completely contrarian. Nobody knew about these stocks. Like my clients were coming and telling me, ये किसने, ये कौन सा स्टॉक है? ये और कोई फंड मैनेजर के उसने तुमने क्यों लिया है?
Sure. Bhavin bhai, I think whatever little I read, it's saying your growth style of, do you follow at your house, or what is it? If you can talk about the style of investing which you follow and that creates.
So I would like to say we generally invest in growth, but at right value. So that right value can mean different things to different people. For us, it means being able to explain the growth outlook of the company into the numbers and buying it at a price from which we can generate returns above our required rate of return. Sounds complicated, but it has worked for us so far.
So it's very easy. Saying value with growth, you're saying growth with value. Now let's let the gentleman what he's saying at the center.
So I really hate to be slotted, you know, between growth and value. I don't know what to call it, but you know, like he said, you can buy value and value can remain value for 10 years. So it's only when growth comes where value gets recognized, and you buy growth at any price, you will suffer. I mean, it's very, very clear. So in that sense, pretty common sense, you buy something where you have the opportunity of earnings growth and valuation re-rating, and you should have a differentiated insight. I mean, I refuse to slot whether
So
it
he's
is
very
growth
clear.
or
I'm going to play
value.
straight bet. I'm in the center. I'll hit a straight four. Another right, another left. Perfect. That's good. So the fourth question that comes in mind, and which again is debated, does buy and hold creates or multi-bagging portfolio or active management creates multi-portfolio? Maybe Bhavin bhai, you want to check, because reading in your brochure, at times you do take active cash calls. Is that correct in terms of there? So maybe start with there.
So I think to start with your question of buy and hold versus active strategy, right? So I think, as Siddharth said, stocks can go from significant discount to intrinsic value to a many multiple of intrinsic value. We find it difficult to figure out if the stock starts to go meaningfully above intrinsic value, when will it change? So we tend to exit when we believe that the incremental return potential has diminished. And as a result, we would exit such position. So we are more active, we are not buy and hold. Sometimes when we look at the performance of the stocks we have sold, we feel that maybe we sold it too early. So yeah, that happens. But on the whole, I think what also the benefit we get is that we are exiting the stocks which have kind of priced in all the expectations. So if something wrong happens, the big correction, we are saved from that impact. So that's sort of the strategy we follow.
Samir, your thoughts, please.
Yeah, so see, you need to give it reasonable time for these multi-baggers to play out businesses. It cannot, 1, 2 years, 3 years is too short a time in life cycle of companies. So if you really want, these outsized returns or capture a bulk of the outsized return, you've done all the hard work in identifying the company, you bet on the company, and it is, you are your own enemy. If you ask anybody on the thing, the biggest mistakes are what we, we didn't buy, or we didn't buy enough, or we sold early. Those are actually the mistakes. It's so for us, we want to identify our mistakes early. So that is where you will see us. If I sell a stock within 1 year, it is mostly because you have a hypothesis, but in 2, 3, 4 quarters you realize that what you thought about the business, the direction is not right. And most of our winners we have seen there. See, we don't overestimate our ability to predict. In fact, you are always going to be wrong in terms of prediction. We don't work with FY26. This will be it, and it will get 40p. So this is the price. That's not how we let it run. The business we see it from a rolling 3-year point of view. And if the story still makes sense, even if it is 40, 45p, so we will let our winners run as long as the company is doing well. Because in this market, who is to say that 30p is correct or 40p is correct? It's an opinion. So market can go to crazy levels, and that's what we are all here for. Where if you've done all the hard work in identifying and building, then we let our winners run, and we want to cut our losses early.
So you're true to your brochure, which says what we don't do is timing of the markets. So
Absolutely.
active management, little bit. I'm saying comparatively more long-term, buy and hold, stay with that and exit if something which is wrong. Now come to my immediate right. Siddharth.
I think, Nimish, so to me, it's about time. Right, today 7 out of our top 10 holdings, right, we've been holding for more than 8 years. And I personally feel, so for a company, typically what I've seen is for a very well-run company in India, in 10 years' time, what their revenue is today eventually becomes their profit. So your idea is to buy it at a very low P multiple. So that eventually, that in a lot of our cases, our quarterly EPS now for companies is more than the price at which we first bought the stock, which is 10 years back. Wow. Because the growth came in a country like India, 15 to 18% nominal GDP growth rate, 15% nominal GDP growth rate, you can find companies which are growing at 20%. The key is to identify them when they're going through a tough patch, right? Second criteria for us is to find the best company in the worst performing industry. Okay. Right? And then hold it for a very long period of time. If your buying price is right, your selling price will not matter. And coming to your answer, I told you I have my own personal experience where I said, if I would have not sold a single stock in 20 years, I would have probably been better off than what I am today, in spite of so much active churning and this. So I think multi-bagger necessarily involves time.
Beautiful. Thank you for the pearls of wisdom, from his own experience, how time has been able to create a lot of wealth for himself and also for his clients as well. Coming to very interesting type, active, passive, come active, and you said, what interesting what I learned from is the multi-bagger is in the buying price. Is that what you said, right? But just a follow-up question, do you get that opportunity, all parts of market, will you get that in this market also, that opportunities?
Very few, right? Like in March 2020, you could have created 10 portfolios of 16 stocks each. Maybe today that those opportunities are not that many. So you don't get that at every point in time, right? And this is the nature of the markets, right? It's bull markets and bear markets. 2020, nobody wanted to buy small and mid caps. And today, it's only about small and mid caps and even SME sector, right? You don't get any more people on panels who are saying buy growth at any price. You're only getting people who are saying buy growth at a reasonable value. Right? So times change.
Yeah.
Right? Times change.
So you're flexible. Another question on the lunch somebody put forward to me, very interesting. Nowadays PSUs are done well. So that brings me the question across there. There are different ownership patterns in the market. Like some are entrepreneur driven, public sector, multinationals, professionals. So do you have any biases in the thought process? You believe that a particular ownership does make a long-term wealth creation? Yeah, Samir, if you want to.
We have our biases, all of us. I mean, we definitely do have our biases. One where we don't understand shorter cyclicals, bad promoters, this thing. Ownership does matter in India. And so, yes, we are biased against, but just to tell you, I mean, we did bet on PSUs when you see your interest aligned. Ownership ke saath, the biggest thing that matters is, are your interests aligned or not? And is it quality good enough? You will not go into bad quality whatsoever. So if you eliminate that and you have decent businesses which have some kind of tailwind or industry tailwind, then, जब industry अच्छा होता है तो सब अच्छा करते हैं. So one, like defense as a sector, you hardly had any private. You had to, if you had to participate, you had to and deploy large capital, PSUs was the only place. So that is where we did make an exception to the rule. You have to be flexible. See, what works now, 8 years later, something else will work. You have to keep increasing your circle of competence. You have your biases, but if data points something where, which you should, that's what, if facts change, you have to be able to change your view. But opportunistic thing, bad promoter, so एक बहुत ही गंदा company है, it has been beaten down, एक बार पैसा बनेगा, दूसरे बार पैसा बनेगा, but yeah, to that extent, quality should not be compromised because long term, otherwise you will not sustain.
So be flexible is fine. Bhavin bhai, do you buy PSUs also and think they can, or you have biases again, what some you said?
So I think PSUs have obviously done very well in last 2-3 years, but if one is investing with a long horizon, I think one is taking a calculated bet that whatever is the reasons why this, companies have come in favor sustains after 2024, for example. So there are, those are, so it's basically a question of what variables we want to play with and which ones we don't want to play with. We have invested in PSUs, it's not that we haven't, but I think our experience has not been consistent. So we are a little shy about investing in PSUs, but there are quasi-PSU type companies where we feel that board has become very focused and is bringing in right management to run the company. We have invested and they have done well for us. So I agree with Samir. We don't want to work with sort of rules written, forever. We want to look at things as they evolve.
So the two gentlemen are very clear, flexible. What is your thought? Do you have biases towards entrepreneurs?
Nimish, Shakira said hips don't lie. I tell my analysts numbers don't lie.
Absolutely.
So at every point in time, what we do is we focus on the numbers. I tell them what you think, what I think. doesn't matter. I have seen the worst of stocks get re-rated, and I've seen the best of stocks get de-rated. Look at ITC. Nobody wanted to touch it 3 years back, right? So, and before that, for perpetuity, ITC has been the darlings of the market. So, for me, it's much more than that, right? Focus on the numbers. Some of the public sector, undertakings were available at 10% dividend yields, and nobody wanted to touch them. And all of a sudden, you have a government here. If the Prime Minister of our country comes and tells in Parliament that, you look what I'm going to do with public sector undertakings, I, for one, know is that he's done what he's, talked. He's walked the talk. So I'm not going to bet against those things. So it's all about why not, rather than why completely avoid or why completely this. Look at State Bank. It's done so fantastically. Look at NMDC, Coal India. They were sitting ducks, and these are the stocks which have done well. It is not your flamboyant names which have done well, right? So a better option is to just own the ETF.
Yeah.
Right. The CPSE ETF was available. It itself has become a 4 or 5 bagger in the last 4 or 5 years. So talking of multi-baggers, it was, even if you didn't want to buy stocks, you could have just bought the CPSE ETF. And it's outperformed most of the indices.
Fantastic. So in all 5 questions, we've not got one consensus answers, right? I think one thing which would create wealth, to my mind, would be their unique philosophy, their style, and their process. So we are looking at the time as well, maybe 2.5, 3 minutes for each of the gentlemen. Many may not know your philosophy. Anybody wants to take it, starting from Samir, 3.5 minutes. What's the philosophy, process which you have, which has created this multi-bagging portfolio in the last decade for you, 7 years for him, 10 years for him? Please go ahead.
So if I have to name it in one word, it is, scale. We believe that there are very few. So if you see how many companies have 50 crore profits, you will have thousands. How many companies have 100 crore profit? How many companies have 500? How many have 1,000, 2,000? So as you go up in terms of scale, the number of companies become rare. And that is why, when they are rare is when they will get the value which is more than whatever the others. So if you are able to find a company which is going to change scale due to industry tailwinds, due to the quality of the management, due to execution, and I would like to harp upon execution. We bet on probabilities more than possibilities. So for me, and in India, we know the kind of hurdles that an entrepreneur, our respect for entrepreneurs is kind of very high. Despite all the challenges, generating the kind of return on capital that they do, we give a lot of premium to execution. And I would rather bet on something which has a 90% probability than a 0-1 game. So, that competitive advantage can come from, execution, network effect, product, brand, wherever it can come from. Which helps them change scale, and what we believe is, this 3 to 5 year is a time frame for the market to recognize the quality. Like everybody loses their shit at the same time, but they gain it, 1% at a time. So that is how it is. The opinions change over a period of time, and that is how you get your re-rating. So our philosophy is that you keep looking for these kind of companies, and we don't need many. I mean, if I get 2, 3 in a year, it's great. That helps me, and I can deploy. I mean, we are sizable. We managed 10,000 crores, and that's what you can deploy, thousands of crores in that and make alpha. So for us, those are the that is the ethos of the organization, and our process is that we do whatever it takes. There is complete skin in the game. We think like investors. We not like money managers that way, and which is why only if something excites you is when you want to invest. Otherwise, you are happy sitting and watching and businesses. So you have to be on the ground. You have to meet companies, competitors. We go to the extent of whatever signing partners is that. Keep looking for disconfirming evidence, and then if you find a company like that which is going to change scale, then you bet on it and sit for the market to recognize and reevaluate. We are custodians of public money, and we can't be reckless about it. Risk management to us is all at stock level. I see, after I buy, no amount of risk management. I can do slicing and dicing, volumes itna hai, liquidity itna hai, all those things don't matter. If you are wrong, you will not have liquidity. If you are right, liquidity will never have a problem. We have bought stocks where, liquidity has been a challenge, 7-8 circuit मार के भी stock लिया है. We have bought stocks over 3 months, 6 months period of time also. So while buying, there is never liquidity. While selling, like he said, the multi-baggers, our thumb rule is also that my buy price is a one-day movement in that stock. So that's what we have typically observed. And the simple thing is returns follow earnings. So you follow earnings, you follow or you try to work on the drivers of the earnings, and you will understand some. And wherever you understand, you bet big, and then
Super. Thanks.
Market.
Bhavin bhai, I was reading is 93% of your clients are direct. Many people would not know. So maybe time is running away, but 3.5 minutes quickly share about your philosophy, which the clients you would like to share with them.
I think, yeah, you are right. 3 minutes is very short to talk about the philosophy. But so I come from engineering background. I used to design microprocessors and actually very advanced microprocessors. And what I learned designing microprocessors is that one has to follow a set of rules. If you don't follow the rules, that microprocessor that comes out of the manufacturing line won't work. So I have tried to create set of rules, set of processes in my career in investing. First 20 years was doing equity research on sell side. I would establish some frameworks, and I would kind of have that followed by my research team, and I have learned from that. I have fine-tuned that. The main thing about that process is that hopefully we check enough things that we are rejecting most companies that are not worth investing. So if I look at our track record, we haven't had too many disasters. The stocks that, people can ask you later, why did you buy this company? We have missed out many opportunities because of that process, but I think that rigorous process has helped us avoid big mistakes. And I come from technology background, and so I basically using a lot of technology in everything we do. We have in-house software development team. So basically putting in place whatever automation we can do to basically follow these rigorous processes, because doing that, it requires a lot of effort. So that I think also helps, and sticking to the framework that I have kind of learned while doing while going to business school, and then evolving that, I think has really helped me in investing in so far.
Super. By rigorous framework, process, lesser mistakes. Interesting. Siddhartha, once again, I want to quote 10-year, 37% tiger. You only have one strategy. So what's that strategy about? We all are curious to know.
Just go out there and buy the best stocks. So, Nimish, to be honest with you, I think investing is a very, very simple process which has been complicated by the financial industry. Right? The more we complicate it, the more sexy it sounds, the more it confuses the client, and they feel that you're doing something really, really nice. Right? It's a very simple process. What's my objective? First and foremost for us, we want to buy industry leaders. Industry leaders, right? We want to buy industry leaders, the best performing company in the worst performing sector. Right? We love it when people say this is a dying industry. Right? Typically, that is when you get good balance sheets at bankruptcy valuation. All right. So that's our first criteria, one of our first criteria. Second to me is the most important thing is corporate governance. I see so many people saying, "Yaar, 10 rupees ka stock hai. Kya hai? 10 rupees jayega." No, it's 100% of your wealth, and especially in a country like India, let's not look at today's market, but historically, 9 out of 10 companies in India eventually delist. In 92 to 94, you had something like 4,000 IPOs that came in within a matter of 3 years. Today, total listed stocks are 7,000. And I've tried going into 60s and 70s to see if there was a similar IPO mania. Unfortunately, we don't have data. But I'm pretty sure every 12 years, there's a Kumbh Mela where the retail investors and the promoters come, right? And the promoters take the money, through IPOs and QIPs. And which is what you're seeing right now. So I wouldn't want to judge the Indian markets right now on the basis of this. So corporate governance to me is a very, very important thing. Third, it's simple. You buy stocks with cash on the balance sheet, available at single-digit PE multiples, and diversify as much as you can. And over a period of time, you will come out and you will get opportunities. The market throws up opportunities every 3 months, every 6 months. At the most, it will happen that for a year, you might not get an opportunity. But eventually, you will get opportunities. And I see it across time frames. Even today, you have companies which are available at, very few, not that many. But you have companies which are available at single-digit PE multiples. So many public sector enterprises were available at 2, 3, 4 PE multiples just a year back. Right? So you don't have to go and create a portfolio of 100, PSUs. But you could have just bought 2 or 3 and then 6 months later buy something else. So that's at an individual level that I'm saying. We at a professional level do it differently. But
so thank you, gentlemen. If I again wear the hat of an investor, I can say I couldn't find one way of creating wealth. So I think I'll wear the hat of an asset manager. And that asset manager tells me that instead of you trying to create a multi-bagger yourself, invest in either of the portfolios, because they have demonstrated for the last decade are more than 25-30% CAGR. So invest in either of the portfolios and don't try it yourself. Is that what I would like to end the panel discussion today? Thank you, PMS Bazaar, and thank you, gentlemen, for a wonderful conversation. Thank you.
thank you. Thanks a lot.